Dear learner, the topic which has been given to me to talk on the International Financial Reporting Standards, a roadmap for India, is a really excellent topic which has been chosen by me. The reason is that the last 10 years and so, it has been a buzzword, like talking about the International Financial Reporting Standards has been prevalent more than 100 nations. We all know that when we have a common language, the language which we understand and the party which is interacting with us can understand always facilitate the business and the other transparencies across the business. That's true. Keeping the same thing in mind, it has been designed, it has been thought of, like every nations when they pursue their own generally accepted accounting principles which they develop keeping their own constants, their regulatory bodies norms and their local norms, and then when they play at the international forum, then it finds a lot of difficulties to further translate these accounting financial statements and then to convey the results to the international investors. It was a difficulty which was felt across the nations. The journey which was started by the International Accounting Standard Board IASB, which is located at London, has been very successful for the last 10 to 12 years. Now, when we say that the International Financial Reporting Standard, which was started way back in 2001 by the International Accounting Standard Board, and earlier which was looked after by the International Accounting Standard International Financial Interpretation Committees, was the body which was looking after this international accounting standards, which were taken over by this International Accounting Standard Board in April 2001 and was renamed. After that, it is being called as the International Accounting Reporting Standards, which we generally acronym has been given as the IFRS. And now the IFRS has been widely acknowledged across all the boundaries, and more than 100 countries are pursuing this IFRS more or less with the same format which has been issued by the IASB, or by bit of changes carrying out, keeping the local regulatory norms or the local requirements, bit changes and then reframed as per the local requirement. My dear friend, I shall be taking forward all the aspects relating to the roadmap, which is particularly has been designed by the India in toto. International Financial Reporting Standards issued by the International Accounting Standard Board, which we call it the IASB, headquartered at London, has assumed the status of globally accepted accounting standards. As I said, before this, it was the International Accounting Standard Committee which used to issue the International Accounting Standards, which was replaced by this body which we call it the IASB in 2001. Dear learners, you will be happy to know that since then, 2001, this IASB, that is the International Accounting Standard Board, has been very actively, promptly, has been working on this common language to develop the common language across the boundaries, that the whole universe can understand that language, the financial statements which are being prepared by this, the corporate multinationals. It is easy to convey the results which is being prepared by these corporates to the different groups who are interested in the business. So keeping all these points into mind, this IASB has started this journey, as I said, in the April 2001. Keeping the further parameters into consideration, this International Financial Reporting Standard are standards and interpretations adopted by the International Accounting Standard Board. And these IFRS, as I said, comprises the following matters. It is the International Accounting Standards 1 to 41, and which out of it 12 out of this have been omitted. IFRS 1 to 9 has been already released. The interpretations developed by the International Financial Reporting Interpretation Committees, or the former standing interpretation committees, which we rename it as acronym as SIC. Presently, there are 9 IFRS, 29 IAS, and 15 IFRIC, IFRIC interpretations, and 11 standard interpretations committees has been released. My dear friend, you would like to know that the Indian local GAAP, which we call at the generally accepted accounting principles in India, the advantage is that the Indian accounting standards, which we earlier used to call as the accounting standards, and after the introduction of these International Financial Reporting Standards, they have been all readjusted, and now we rename them as the Indian Accounting Standards. The advantage to the Indian side was that the accounting standards which we adopted has to a great extent compatibility with the standards issued by the IASB, that is the International Accounting Standard Board, in the name of, we call them the International Financial Reporting Standards. So that advantage India has enjoyed, that the already existing local GAAP has to a great extent has the compatibility with the International Financial Reporting Standards. My dear learners, moving further to the presentation, the question arises that why the International Financial Reporting Standard is mandatory in the given environment. The environment comprises of the universal environment. So coming to the point, in the existing setup, multinational companies are required to prepare the financial statement under different set of accounting rules. All you understand, the multinational companies, the MNCs, are the companies which they have the businesses, not only one or two or some countries. Some of the multinational companies you will find they have the business in more than 100 nations. Their presence is felt across the globe. Everywhere they have the business. This kind of companies, we call them the multinational companies, we call them the transnational companies. These companies, when they prepare their financial statement at the end of the accounting period or at the end of the financial year, they have to comply with the local accounting standards wherever they are locating their business. So for them it was the difficult task. First they have to prepare the financial statement depending upon the requirement of the local rules and regulations, and then wherever the company has its headquarters, like if the company belongs to the US, then if the company is headquartered in the New York, then again the company has to translate these financial statement as per the GAAP which is prevailed in the US. So this was the difficulty which was very prevalent, and by introduction of this IFRS, certainly there will be a big sigh of relief for this multinational as well as the different investors, kind of the investors and the different parties who are interested in these multinationals. First, under the local GAAP, to meet statutory and regulatory requirements. The secondly, under the different GAAP, these gaps are what? These are the generally accepted accounting principles based on accounting where its headquarters are located or securities are listed, which require extra efforts and cost. As I discussed, that not only it will help out to present the financial statements at the host countries where the particular branch or the multinational company has a business, but at the same time it will certainly help in the regard that when the companies are listed their stocks or the shares on the various stock exchanges, with the help of those companies who adopt the international financial reporting standards, which we call it the common accounting language, will certainly help these multinational companies to list their shares at any part of any stock exchange across any part of the world. This problem will be overcome by certainly under the IFRS regime. That's true. Moving further, I would like to come to the point. In the current free trade economy, there is this increased mobility of funds and resources. That's true. Capital markets are getting integrated. IFRS will facilitate cross-border listing of securities, thereby attracting more foreign investments. As we discussed earlier, and I would like to refocus this point, that when we will have the common language is called as the International Financial Reporting Standard, it will certainly help the companies to list their share across the boundaries. The major international stock exchanges, whether it is a New York Stock Exchange, London Stock Exchange, Tokyo Stock Exchange, Singapore Stock Exchange, these all the companies, the multinationals who will be having this IFRS, they will find, with little ease, they will be getting these stocks listed on these exchanges. There's no doubt in that. Now, the second advantage or the need of this IFRS can be emphasized through the globalization of the capital markets is crucial for establishing a uniform set of financial reporting rules across the boundaries, across the globe. This has been a major driving force behind the convergence of accounting standards across the globe. That's true. That has been re-emphasized as this was focus. US has its own local GAAP, and US has already is working on it, that to make its local GAAP, generally accepted accounting principles, incompatible with the GAAP, the IFRS issued by the IASB. IASB here is the International Accounting Standard Board, as I discussed in the beginning of my in the beginning of my lecture, that it is located in the London. It was the major part. Question here arises that it was the Europe which pursued this IFRS at the beginning, and it was the leader in adopting these international financial reporting standards. It was the first Europe which started this journey. This journey was very soon across the boundaries from the Europe and came to the Asia and the rest of the world. China, Japan, Singapore, many more countries, India, everybody started this journey, and now this journey seems to be, as I said, as far as India is concerned, we have chalked out a roadmap, how this implementation of the IFRS will be completed by the year 2014-15. That roadmap I will be taking that schedule which has been depicted as the roadmap of this implementation of the IFRS. I will be taking this matter in my successive discussion. My dear friend, this has been a major driving force, as I said, that coming out with the IFRS was one of the major force was the capital markets. The capital markets, as I discussed, when we have the common accounting statements where everybody can understand the same language, same parameters, same methods of preparation, whether it is a balance sheet, whether it is a profit and loss count, or the cash flow statement, or the other equity statements, then it certainly find it comforts and ease to understand the financial position of that particular company by each and every stakeholders who are interested in the business. The evolution of the international financial reporting standards marks the biggest revolutions in the financial reporting. As I discussed, this will not only facilitate to the international trade and business and the listing of the securities across the globe, and then they promote the international business and the financial stability, but at the same time it is a big revolution in terms of the financial reporting, which will bring the transparency into the system. The transparency across the different the globes, parts of the world, it has been re-emphasized one time and the other time, because financial reporting has been manipulated by many corporates at the different points in time, and that has been the concerns of all the stakeholders, whether it is the government or whether it is the shareholders or the other stakeholders who are interested in the business, to ensure that the business brings the transparency into the system, because the different stakeholders who are interested in the business should not feel cheated. So this certainly will be a big lap in the hands of the different stakeholders. Through this, that transparency and honesty will certainly prevail upon in the time to come. Moving further, the questions come, the implementation part. How does it will be implemented? Implementation of the IFRS converged standards would help in bringing excellence in financial reporting. That's true. Easy for comparison. It will be certainly easy, because now when I say a multinational company which is located its overseas branch or is doing a business in India, the subsidiary which prepares its financial statement as per the Indian local GAAP and then converts the same financial statement as per its hometown, that is the company where it is headquartered, the company where it has been registered as per the local company act or whatever the law of the land is there, then certainly the two methods of preparation of the accounting statements or the financial statements will not have the compatibility. And in understanding this, that makes the comparison very difficult. Some way you find that a multinational company located in India, a subsidiary of the same company, prepares these statements in a different manner. The same company which has the subsidiary in other part of the world prepares its financial statements as per their own local GAAP, that is the generally accepted accounting principles. Then comparison between these two subsidiaries and ultimately with the other companies in the same industry it was a difficult task. It was manipulated over the period of time, and the manipulations was a loss to the different stakeholders when they feel cheated out of the statements or the financial statements reported, or like we say, if the statements have been cooked to their respective, to their advantage. So now with the introduction of this international financial reporting standard, this advantage or this problem will have a edge. That's no doubt into it. Then globally understand ability. This globally understandability will make the investments and the stock listing will be certainly an advantage. When the people across the different nations, they don't able to understand that these financial statements depicts what this particular methods tells what, then if we have the common language and the common standards, then certainly it is going to help the investors across the globe. Means people from the various nations will start making the investment from one country to the other nations. So that will certainly infuse the flow of international capital from one nation to the other. That is going to help the world across the globe, and it will facilitate not only the international trade but at the same time the movement of the international capital. This is what is required to have the development of the whole nation, the whole world. It is required that the movement of capital, goods and services should be without restrictions and should be in a fair and transparent manner. This is going to be promoted, to be helped by pursuing the international financial reporting standards. As I discussed, transparent and will be helpful to investors for taking informed decisions. This is very important. The investors, when they make the investments from one company to the other company, or whether they change one business line to the other business line, it should mean the financial statements which they provide the different financial informations, if they will be able to understand the way they want it to, then certainly it will provide an edge to these investors to take an informed decisions which they already know it, that whether it is right or wrong or how much risk is involved into it. So that will certainly bring the quality of the investments. That's true. With this, the quality reporting, the investors would not need to compensate for the lack of understanding by demanding a risk premium. So this, as I discussed, by taking the informed decisions, when the investors are equipped with this kind of information, means all the financial parameters, the financial understanding, compatibility is good, then certainly it will help the investors to take the risk, which will be informed one and which will have the less risk bearing. So that will be certainly equip the investors to take good financial decisions. Now, my dear learners, moving further to the discussion, the benefit of international financial reporting standards can be laid down as follows. Under the international financial reporting standards, the financial statements will be prepared by applying a common set of consistent standards. The standards which we, as in the beginning of the discussion I picked up, are issued by the International Accounting Standard Board, will have the common accounting language across the boundaries, across the globe. This will improve quality of reporting, no doubt, facilitate easy comparability with the global peers, enhance the image of the companies. These 3-4 things will certainly have an advantage over the local GAAP or the accounting standards, whether it is local accounting standards or the international accounting standards pursued by these corporates. By adopting these international financial standards, will have the advantage in terms of the quality reporting, facilitate easy comparison or with the global peers, and it will enhance certainly the image and branding of those multinational companies. And this is what advantage out of this common language these multinationals will drive out of it. Then moving ahead, with the consistent application and resulting comparability, investors, analysts will make an easy time knowing how to best allocate capital. This is very important. We all understand the different sources, whether it is called as the human resources, call it the capital resources, or the other technological resources, or other different formats of the raw materials. It is always in the scarcity. So through this common accounting language, the capital inflow, as I discussed, through the listing of the norms of the stock exchanges will get facilitated, which will certainly improve the capital inflow from those countries which has the excess capital to those countries which are capital starved nations, and it will certainly help both the ways. One way, these nations which has the excess capital, they will able to earn at a reasonable rate of return by investing the capital in those nations where it is capital deficit nations, and at the same time those nations which are not having the adequate amount of capitals, the capital for them investment will certainly bring the other advantage side by side. Going for the industrialization will help the people to get the employment, the goods and services available in the market will be of the quality and price competitive, and the governments will certainly get the different kind of taxes, and the other stakeholders will certainly also be benefited by pursuing this all kind of inflow and outflow of capitals from one nation to the other nations. With consistent applications and resulting comparability, investors and analysts will have an easier time knowing how to best allocate capital. Having one financial reporting language reduces preparation and audit cost. That's true. Now, after discussing the basics of the International Financial Reporting Standards, its benefits, its advantages, its need and all, now we move on to the next components of the financial reporting standards. As per the IFRS, your financial standards will comprise what? Your financial statements, as I said in the beginning, that the advantage with the Indian local standards, the Indian accounting standard has, is that we already have a compatibility with the IFRS to a great extent. That is what in our local GAAP we already prepare the statements, is called as the balance sheet, is the income statement, or they call it the profit and loss account, or the cash flow statement, which record the movements of cash inflow and outflow. But if you look at the requirement of the newly introduced International Financial Reporting Standards, which has the more or less same requirements. As per this, the financial statement, which we call it the balance sheet, is otherwise known as the name of the position statement, has to be prepared in the same way and the manner which is required by the Indian accounting standards. The second statement which we talk about here is the income statement. The income statement, which we call otherwise is the profit and loss account, is more or less prepared in the same way. The different accounting norms and the rules and regulations in terms of the inventory management, in terms of the depreciation accounting, has some impacts from the IFRS to the local GAAP. That's true. We have to analyze this, particularly the depreciation accounting and the inventory management. These are to be aligned as per the newly framed accounting standards, which we call is that compatibility has been done for our accounting standards along with the International Financial Reporting Standards. The Government of India, through its Ministry of the Corporate Affairs, if we look at that, all the accounting standards from 1 to 29 has been arranged, or rather say it has been incorporated or has been made compatible as per the International Financial Reporting Standards, and after making them compatible, now we call them the Indian Accounting Standard, which were earlier known as the Simple Accounting Standards. As per the Indian Accounting Standards, earlier the statement called is the changes in the equity was not prepared, but as per the now new our Indian Accounting Standards, which has been made compatible to the International Financial Reporting Standards, so this new statement is to be prepared now. The statement is called as the what the changes has taken place in terms of the equity during the given period. The period is the one financial year, or call it the one accounting period. This statement is other statement is called as the cash flow statement, was the requirement under the Indian GAAPs, as well as the requirement exists in the same requirement as we find in the IFRS as well. So the same way the cash flow statement, which is prepared as per the local GAAP, the Indian GAAPs, is called as the by two ways. We call it the direct method or indirect method. Both the methods are worthy, but generally we follow the direct methods, under which we distinguish or bifurcate the various flows, inflows and outflows of the cash under the operating activities, then investing activities and the financing activities. And then at the end of this statement particularly help us or the business to know that what is the state of the cash in a particular given in time, so that the business can plan about the excess cash or the shortage of the cash if it is going to take place in the time to come. So it is a wonderful statement which helps the business or the corporates in doing the financial planning for the particular company. Moving further, the fifth requirement under the financial statements is the notes, comprising a summary of significant accounting policies and the other explanatory informations. These are as usual required under the previous, or we call it our local GAAP as well, but under the IFRS it has been further strengthened and made compulsory to provide this kind of informations. Dear learners, moving further, taking the various aspects of the International Financial Reporting Standards, now I would like to apprise you on the current status of this International Financial Reporting Standards as far as it is concerned in India. Dear friends, the Indian government has decided to implement the IFRS converged accounting standards issued by Institute of Chartered Accountant of India and notified by the National Accounting Committees on Accounting Standards, and not to adopt the IFRS issued by the IASB, that is the International Accounting Standard Board, in totality. What does it mean here? It was decided that whatever the IFRS has been issued by this international body, it is that all these IFRS will be studied and looked into from our local requirement, our regulatory norms, our local environment, which will be, not able to, disturb our existing system. So that is whatever the accounting standards we have from 1 to 32 or 1 to 34, that all this task has been done by the Institute of Chartered Accountant, as I said, under the National Accounting Committees, which is a part of in the Finance Ministry, and which adopted this, and this task has been done by this committee wonderfully, and they have converged all these international financial reporting standards one by one in keeping the requirement of our local standards, which suits our regulatory bodies norms, which suit our various stakeholders norms, and which does not disturb our local environment, and ultimately it helps in the international body, that is the IASB, to even implement the international financial reporting standard as well. So as I said, the Institute of Chartered Accountant of India has so far formulated 35 Indian accounting standards, which we call them as Indian accounting standards converged with IFRS, and the same have been notified by the Ministry of Corporate Affairs on 25th Feb 2011 on the recommendation of the National Accounting Committee on Accounting Standards. As I said, this is the procedures. That procedures is being followed by this committee. They make the recommendations. On the basis of the recommendations, that concerned ministry takes the decisions, and after that, these converged accounting standards, they becomes the Indian accounting standards. So the journey which was started by India, that is the Ministry of the Corporate Affairs has played a very vital role here, prepared the roadmap for the implementation of these international financial reporting standards, converged accounting standards in India in a phased manner. As I said that the Government of India has prepared a roadmap. The roadmap means how over the period of next 3-4 years, how they have laid down the terms and conditions for the various corporates depending upon their net worth, the type of their business, and then the market value and the other conditions into mind, and then they have laid down the procedure. The procedure which has been laid down by the Government of India in the process of implementation of this IFRS for the various corporates and for the various industries is as follows. If you look at the year 2011, the first we said it is in the 2011 it was made mandatory for all the companies which are listed on the NSEs. As we all know, NSE Sensex comprises of 50 companies, market value. Based on that, the NSE Sensex is, the Nifty is composed. Then all the BSE companies which are listed on the BSE, which comprises the 30 companies, they will all mandatory. This was mandatory for all these companies to implement the IFRS. Then companies whose share or other securities listed outside India, they compulsorily they have to go for IFRS in the last year itself. The company listed or not, it is not compulsory. Whether it is listed or not, having a net worth as we said is a share capital, equity share capital plus the surplus and reserves put together, we call it the net worth. If it is in excess of 1000 crores of rupees, then it was mandatory for these companies falling in this particular group. Compulsorily they have to go for the implementation of the IFRS the last year itself. Coming down to the 2011, this year it was made compulsory for all the insurance companies falling any, irrespective of the capital markets, irrespective of their net worth, they were supposed to implement the international financial reporting standards from this fiscal year, that is the 2012. My dear friend, moving further, the 2013, the government of India last year in between has proposed some changes and then brought into some leverages to some companies, so that they wanted to give some more time to some corporates to ensure that the transition phase, the implementations phase goes smoothly without any interruptions, and at the same time the regulatory bodies do not find any difficulties in looking after the various aspects of the implementation process of the international financial reporting standards. As per the 2013 process, all the companies, whether it is listed or not listed, having a net worth between rupees 500 crore and rupees 1000 crore, they all need to be listed from the next year. All the scheduled commercial banks, they are supposed to be implement the IFRS from the next fiscal. The urban cooperative banks having a net worth in excess of rupees 300 crores are also supposed to implement IFRS from the next year. All the NBFCs, we call them the non-banking financial corporations, whether it is a Nifty or the Sensex, means BSE or NSE, the NBFC listed or not is not the condition. The condition is that they should have a net worth more than 1000 crores of rupees. They all have to implement the IFRS from the year 2013. Means from the 1st April 2013, they have to implement the IFRS in their presenting the financial statement. These statements which are to be prepared by these companies, as I discussed, has to prepare in the light of our changed accounting standards, which we have made compatible and converged with the international financial reporting standards. As far as the year 2014 is concerned, which is the road journey of our IFRS, the listed companies having a net worth of less than rupees 500 crores will be going for this implementation from the year 2014, and the urban cooperative banks having net worth of between rupees 200 to rupees 300 crores, they will also have to implement these international financial reporting standards. Call is as per our Indian accounting standards from the fiscal year 2014. The NBFCs, as all other listed NBFCs, the unlisted, having net worth between rupees 500 to rupees 1000 crores, they all have to go for the implementation of this converged accounting standards with the international financial reporting standards, has to compulsorily adopt this process from the financial year 2014. And as I discussed, the companies which are not falling in this roadmap journey, they can automatically or as their discretional as its discretions, they can go for the implementation of the IFRS. Absolutely, there won't be any problem. But as we talked about the different segmentation we have done based on the BSE, NSE listing, based on the net worth parameters, based on the different line of the business, means the insurance companies, the non-banking financial corporations, or the banking industries, as I discussed during this my presentation, it will be followed as the schedule provided here. Now in this process, moving further, the Government of India, the Ministry of the Corporate Finance, Corporate Affairs has issued new schedule, the Schedule 6, which provide the laid down procedure for presenting the financial statement in a given standard. The Schedule 6, which was earlier prepared by these corporates, was slightly different. Now the new schedule, which was released last year in the year 2011, has been made compatible with the changed, or rather you say has been converged or made compatible with the International Financial Reporting Standard, so that the statements which are being prepared by the Indian corporates are compatible, are comparable, are transparent and easily understood by the people across the globe. This is what the intention has been. To execute that, I will take you through the new schedule 6, which has been released recently by the Ministry of the Corporate Affairs, which is as follows. The first part which I will be taking through you is called the balance sheet. This is the format of the balance sheet, where you will find the name of the company, the balance sheet as so and so date. The balance sheet we always write as at so and so date. It's not for a particular period, because it shows a particular business, the position of the business on a particular date. The date on a particular date, as I said, the before and after the things may get changed. So it will provide you in a vertical format, where you will find the particulars. Any note number is there which has the linkages with the explanations, they can be provided here. Then the amounts may be written in the rupees or the local currencies, whatever it is. Then the figures along with the current reporting period, you will find that the figures of the previous periods is also shown. Of course, it was shown in the previous the schedule, which was the earlier schedule was also there, but here some parameters you will find has been changed entirely. Just look at the way the equity and liabilities you have to show in your balance sheet. The shareholders' funds, it will be shown like this: the share capital, then followed by the reserves and surpluses. The reserves and surpluses are created by the company for the various purposes, and the company or the corporate's business always thinks that some part of the profit is to be retained by the firm or by the corporate, in order to, they may have some requirement, investment, some projects which seems to be lucrative or beneficial for the time being. Then it is some part of the profit is always kept in the different form of the reserves and surpluses, because as we see that this is what we call it the internal source of financing, and internal source of financing is the cheap and best method for the company or the corporate to finance its any worthy projects which are likely to come up. The other aspects of the cost of capital and the opportunity cost and the risk factors are to be analyzed by the planners or by the financial wizards. Moving further, the money received against the share warrants are to be incorporated here, are to be displayed here. The share capital money, pending allotment, etc., if anything is there, that is to be precisely mentioned here. In the earlier format, as we used to see the authorized capital, the issued capital, the paid up capital, unpaid capital, etc. Now these all informations has been summarized in the format which I just shared with you. The non-current liabilities will be shown under the different heads, starting from the long-term borrowings, deferred tax liabilities. It will be shown here as net, and then moving further, it is other long-term liabilities. The long-term provisions are also to be shown here. Under the head is called as the non-current liabilities. So non-current liabilities here means these liabilities are to be executed or to be paid beyond 1 year. So all the liabilities which are to be executed within the one accounting period, within the one financial years, will be called as the current liabilities. Under the current liabilities, these are the different heads which you have to cover all the current liabilities under these different heads. These will be named as short-term borrowings, trade payables. Trade payables here in the sense that when the business purchase goods and services on credit from its suppliers, then we call them the trade payables. We call them the accounts payable also. We call them as the creditors also. These are the different synonyms of the trade payables. But it is always termed as the current liabilities. It is expected that this liability is to be paid within the one accounting period. The other current liabilities may be of the various natures, but the parameters, as I said, will be the same, that all the liabilities which are falling under the current liabilities will be those liabilities which are to be executed, which are to be honored, which are to be paid within the same accounting period. Short-term provisions, long-term provisions are to be shown under the non-current heads, but the short-term provisions are to be shown under the head the current liabilities. Dear friends, this will be this format of the financial statement as per the Schedule 6, which has been, as I talked, has been recently changed as per in the light of the given statement, in the light of the changed financial standards, which we call them the International Financial Reporting Standards. Moving ahead, we had the assets parameters. The assets parameters at the same time has to be shown under the non-current assets or the current assets. The fixed assets, which is we call them the non-current assets, maybe the tangible assets, maybe the intangible assets, capital work in progress, intangible assets under development, etc. I would like to focus here that the fixed assets, what we call the parameters, like all the assets for the investment has been made by the firm or the corporate, they will be enjoying the benefits more than 1 year. Depending upon the nature of your assets, it will be maybe the minimum, the benefits from the investments, which we call them the fixed assets, will be minimum, it will be more than 1 year, maybe 2 years, or depending upon your nature of the assets, maybe 10 years, or maybe if it is land and building, maybe 50 years, and all the other kind of the assets. Tangible and intangible assets, as we talk here, those assets which can have the physical appearance will be called as the tangible assets, like land and building, furniture, etc., and so on, so forth. And intangible assets, we call them in the category of that, where the benefits are certainly to be enjoyed beyond the the one accounting periods, maybe at least 2 years, and maximum maybe any time, depending upon the nature of the assets. But intangible assets generally comes in the form of where we cannot touch them and we cannot feel them, but certainly we have those rights, like the trademarks, like copyrights, patents, etc., other goodwill, etc., all will fall in the category of these intangible assets. The capital in work, the other intangible assets which are in the process, they will all fall under the category of these fixed assets, or rather you say that is the non-current assets. Non-current assets. Moving further, non-current investments, the investments made for the longer period, maybe 2 years and so on and so forth, but within the same year, if you have the investments are to be realized, they will fall under the category of the current assets. I will be taking you hurriedly the other types of the current assets. The current assets, as I said, when I referred the current liabilities, the same parameters applies here as well, that the current assets will be those assets which can be realized into cash, can be converted into cash within one accounting period, will be called as the current assets. Whether it is a current investments made which will be get converted, the investments may be for a shorter period, maybe the 3 months, maybe the 90 days, or call it the 6 days, 180 days, or maximum it could go up to 1 year, 360 days and so. But that will be get converted into cash within the 1 year. The inventories is in any business firm. The most of the current assets in a manufacturing assets, in the manufacturing type of the companies, the maximum amount of the current assets are being invested in the form of inventories. The inventories may have the different formats, maybe the raw material, the work in process, or maybe the finished goods. But the inventory expenditure under the head of the current assets is the largest one. And as I said, if the company is the manufacturing, then it goes up to 80+%. But in case of the service providers company, naturally the inventory amount has to be very, very limited because of the nature of the business. Then the trade receivables, as I discussed in the previous, when I was talking about the trades payables, it is like when we sales the goods and services on credit to our customers, we create trades receivables. It is all the terms and conditions the company or the firms or the business has with its, the customers, maybe depending upon the terms and conditions, the discounts, etc., is to be granted to the customers in order to make the early payment out of the credit period granted to them. This which we call it the cash discount, is all techniques to advance the payment on account, the out of the trade receivables. Dear friend, as I said, the trade receivables and the excuse me, is going to be is the part and parcel of the business, which the business at certain occasions cannot avoid it. But trade receivables, when it comes, the business will always try that the trade credit period is to be minimized. But when the question of the trade payables will come, then the firm will always try to enlarge the period, to increase the period, because that is the advantageous when they will increase the period in terms of the trade payables. But when the question of trade receivables comes, means when you have to sell the goods and services on credit, and out of that, as I said, we create accounts receivables, or call them the debtors as well. They are one and the same thing. We will always try to provide them the minimum time to grant the credit, so that the business can be run at the competitive terms, and the business will always be able to run with the less amount of the working capital. Because the larger the period of the trade receivables, larger amount of the working capital will be required for the firm, that the firm has to look into it. As I was talking about the different aspects of the implementation process of the International Financial Reporting Standards, at the during my discussion, I picked up these two issues, that is the depreciation accounting and inventory management. These are the two gray areas where the compatibility in terms of the international financial reporting standards was supposed to carry out, and it was done by bringing the compatibility with the international standards. The other parameters of the current assets are the like cash and equivalents, maybe the cash and the cash equivalents, maybe the cash available with the banks, and the other short-term investments or the checks, notes, etc., drafts which can be converted into cash at any point of time, the short-term loans which can be realized within on accounting periods, and the advances which has been granted for a short period or the can be received back within the one accounting period, or may fall in the other category of the current assets. As I said, the criteria remains the same. The criteria means that the assets which can be converted into cash within one accounting period will be called as the current assets. So dear learners, I have taken you through the parameters of accounting, and that is to the international financial reporting standards, which has been a buzzword for the last 10-11 years, and more than 100 nations has adopted this new accounting language, which will, as I summarized in my discussion, that will be facilitating in the movement of the international capital from the one nation to the other, will able to allow the corporates to get listed on the various stock exchanges, will bring out the helps in doing the comparison between the various multinational companies, and will bring the transparency and honesty into the whole system. This is what is my whole discussion. Thank you to all.